Welcome to this explainer. Okay, let's dive right into this because today we're looking at a frankly fascinating and kind of terrifying structural market risk, and it's just sitting quietly in millions of everyday investment portfolios. We're drawing on veteran investor Rick Rule's analysis to uncover a massive hidden danger regarding high-yield or junk bond ETFs, and exactly why these incredibly popular vehicles carry a systemic risk that very few people actually appreciate. If I had to think about one thing that really scares me, that's it. Let that sink in for a second. When a seasoned market veteran like Rick Rule, someone with literally decades of experience evaluating global assets, talks about the single thing that truly frightens him, well, it definitely demands our attention. We're about to unpack the incredibly high stakes of what happens when the illusion of safety collides with a highly fragile financial reality. Section 1. The Rising Rate Threat. Rule observes a really simple but totally unforgiving mathematical reality in the credit markets. I mean, think about it. If stressed creditors are already having trouble servicing their debts at a 7% interest rate, they are going to have a massive amount of trouble at 9%. It's just common sense, right? As interest rates go up, they constrict overall credit in the economy, they devalue existing bonds, and they severely hamper the ability of already distressed companies to simply survive, let alone pay their bills. Section 2. The ETF liquidity illusion. You can kind of think of these investment vehicles like a giant iceberg. On the surface, high-yield or subprime credit ETFs are these massive, shiny funds holding literally trillions of dollars in assets, and they're heavily bought by everyday retail investors. But just below the waterline, out of sight, those same investors are largely unaware of the true underlying credit risk they're actually taking on by holding these funds in, say, their retirement accounts. And this really brilliantly illustrates a core structural flaw here. See, the ETF wrapper itself is highly liquid. You can buy or sell shares on your smartphone in a matter of milliseconds, right? No problem. But the actual underlying assets, the junk bonds sitting inside that wrapper, are highly illiquid. It's a fundamental and honestly dangerous mismatch between the wrapper you buy and what's actually sitting inside it. To give you a concrete idea of just how illiquid those assets truly are, consider this absolutely staggering metric from the source material. Some of these underlying, over-the-counter, high-yield bonds trade just once every 6 weeks. Yeah, 6 weeks. Imagine the tension there. You've got this retail ETF promising daily, even second-by-second liquidity, but it's completely reliant on an underlying bond market that might only see a buyer once a month and a half. Section 3. The Run on the Bank. Okay, so how does this actually play out? The mechanics of a panic in this structurally flawed system trigger a really brutal chain reaction. Step 1. Broad macroeconomic credit concerns prompt a mass sell-off of ETF shares. Step 2. ETF managers are mechanically forced to fund these redemptions with cash. They don't have a choice. And step 3, to get that cash immediately, highly illiquid bonds have to be pushed out to the market overnight. And as Rule points out, if you're forced to sell an illiquid bond overnight, the fire sale price you get, it doesn't reflect the market's distress, it reflects your absolute desperation to raise cash. This creates a frankly terrifying reality for retail investors. As the quote goes, if they head for the exits, there's no exit. Investors believe they can sell at any time because, well, they trust that ETF wrapper. But in a mass sell-off, the actual cash to pay everyone out simply does not exist. It's just not there because those underlying bonds cannot be sold fast enough to cover all the redemptions. Section 4. A repeat of 2008. Now, the source material hypothesizes that this wouldn't just be an isolated problem for a few bond investors. A failure to fund ETF redemptions could create immense broad market nervousness. I mean, think about if millions of people suddenly realized they were locked out of their own money. It could trigger a true test of system failure, cascading into a widespread panic that's highly reminiscent of the 2008 financial crisis. Now, usually when we think of 2008, we think of the government stepping in to save the day, right? But we really have to compare the macroeconomic backdrop of 2008 to the present day to understand a totally critical difference in the government's ability to actually act as a safety net this time around. Back in 2008, the aggregate debt of the U.S. federal government was about 40% of GDP. Today, that on-balance sheet debt is hovering at roughly 120% of GDP. 120? The sheer scale of this financial hole makes the idea of a massive bailout significantly more complicated today than it was back then.
Section 5. The Fed's Tied Hands. Unlike in 2008, when the Federal Reserve could just step up to the microphone and confidently promise to do whatever it takes to backstop the banks, things have definitely changed. Rue explains that because of the current massive debt burden we just talked about, the market might now look at the Fed and say, you know what, you just don't have the ability to do what it takes anymore. The reasons those rescue capabilities are so restricted are pretty fascinating. I mean, they're kind of boxed in. The government cannot realistically raise taxes enough to fund a massive bailout, nor can they responsibly increase an already bloated deficit. So what's left? Their only real option is unlimited quantitative easing, basically just printing money. But as the source explains, in today's environment, flooding the system with printed money would be disastrously, wildly inflationary. Now, it's entirely possible that if a catastrophic freeze happens, the Fed will still attempt to intervene, simply because they feel they have to do something. However, the source material notes that the resulting damage of that intervention could actually be worse than the disease. Bailing out these structures by printing trillions more could destroy business confidence, shatter credit confidence, and ultimately threaten the sanctity and global standing of the US dollar itself. So, with trillions of dollars wrapped in this ETF liquidity illusion and a Federal Reserve constrained by massive national debt, we have to ask, if retail investors head for the exits and there is absolutely no exit, who is left holding the bag? It's a systemic risk hidden in plain sight, and definitely something to seriously consider as you evaluate the true structure of the assets sitting in your own portfolio. Thanks for joining this explainer. Keep asking questions, and always, always look beneath the surface.